Hello YouTube, this is the Accounting Tutor again. I've decided to re-release my video on assets because whilst I was doing my video for explaining liabilities, I thought the format should be changed slightly to give a bit more information about what types of assets exist and actually where they are on the balance sheet itself. In addition, there's one part of my last video on the definition of past events which I thought could be explained better and actually excluded a key part of the definition, which was a definition of constructive obligation. Therefore, this video is being re-released in a different order, in a slightly different format, and I hope it gives you a bit more information that you're looking for about what assets are. Assets are part of a company's financial position, also referred to as their balance sheet. The balance sheet overall makes up a snapshot at any given point in time of what a company's owners own and owe. Assets are the top part of this balance sheet usually, and are split into non-current and current assets. Current assets are assets that are liquid, and by the term liquid it means they are convertible into cash within a normal operating cycle of a company, which is usually a 12-month period. So their value can be realized for cash at a point in time within 12 months. Non-current assets are not expected to be converted into cash or not expected to be liquid over a normal operating cycle or 12-month period of time. Together, the assets, liabilities and equity make up the company's financial position, and always remember the formula: assets will equal the liabilities plus equity of a company. We will go through the various classifications and items that make up assets in general at the end of this video. Okay, so now we know where they are on the statement of financial position or balance sheet. What are assets? How do we define them from an accounting perspective? Now, in simple terms, you may think of assets, as I referred to in my last video, as just things that you own, or something that if you were to sell it, you'd get some money for it. But what are assets really, and how are they defined from an accounting perspective? Well, the definition of an asset is given in the IASB Revised Conceptual Framework in 2018. But essentially, it's already been defined for you within the accounting framework. So what's the definition? An asset is a present economic resource controlled by the entity as a result of past events, and not forgetting that its cost or value must be able to be measured reliably. But what does that all mean? Well, we're going to define the different elements in that sentence and explore them in more detail to give you a clearer understanding of what an asset really is. So, let's look at the first part of that sentence again. An asset is a present economic resource. So let's look at these words, economic resource. What does that mean? Well, interestingly, this is also defined as per the IASB Revised Conceptual Framework of 2018. Its definition is that an economic resource is a right that has the potential to produce economic benefits. Clear as mud, right? Okay, let's look at that again. An economic resource is a right that has the potential to produce economic benefits. Now, the key bit to understand in this sentence is what the term economic benefits mean. Now, in normal cases, it would just mean a cash inflow, as in, I'm giving up something, an economic resource, yep, and I'm going to get something for it, and that's usually money. But this isn't always the case. So let's look at what the different types of economic benefits could be. Okay, number one is simple, and it's the example I've given. If you sold the right or the item or the economic resource, then you would receive cash or something of value in return. Now, this is normal selling and receiving cash, just like you do on eBay. You sell something that you have and you get money for it. Now, the item you could be selling could be covered by anything. So the item or the asset is covered by a wide range of different things within this definition. Could be stock. Yeah, if you're a clothes shop and you're selling clothes, you're getting money in return for selling those clothes. You know, let's say you're the same clothes business and you have computers, but you don't really need some of those computers anymore, so you sell them for money. So those computers are also assets. It could be shares in the stock market that you're selling. Could be trade receivables that you're getting money for by selling them early. So your normal economic benefits are the normal selling of goods and getting money in return for it. But let's go into what they also could be in option 2. So they could be cash that you receive or a cash equivalent that you receive because a contract is already in place. Yeah, so you will receive cash from contracts that already exist. So what could this be? Could be a receivable, right? So you already have a contract in place for work to be undertaken, and you've sent out an invoice to receive that in the form of a contract, and you're due that money because the work has already taken place. So receivables. Or it could be accrued revenue, whereby the work has taken place, you haven't billed yet, but you are owed this money. Yeah? You're owed this money. So you're accounting for it in that way. Okay, let's go to another option. What is the third type of economic benefit? Well, this is the first time we're going to explore something where there is no direct cash involved. So number 3, an economic benefit could arise if it will assist in creating goods or services with or without other resources. So it will assist in creating goods or services directly or indirectly. So let's have a look at this. If you're a building company, well, the machinery, you're not selling the machinery that you have. That isn't the main part of your business. But that machinery is helping you build houses or build whatever it is you build, and then you're going to make money from selling that thing. So that machinery is helping you create your normal good or service. Computers, it helps the employees do their work and makes it more efficient, which helps the company make more money. Cars. Now, they may be stock if you're a car seller or a car leasing company, but otherwise they help individuals to do their work in a more efficient way. And then you have things like intangibles, like IP or trademarks or licenses. All of these items allow companies to produce products that others cannot. Yeah, so they aren't there. This isn't the thing that's creating the product, but it gives you a certain right to create that product. Okay. So what's the next type of economic benefit? So this economic benefit is, it is an item that can enhance the value of another economic resource. Now this usually occurs when we are repairing or adding to an asset something that increases the longevity of that asset or increases the value of that asset. So we'll cover later that normal repairs and maintenance don't enhance the value of an asset, don't enhance the longevity of an asset. However, let's take a plane. If you replace the engine of a plane, or you replace the wing of a plane, that is a significant portion of the asset itself. And without that portion, that asset may not be able to run and may not be able to create any money for you. And therefore, by replacing it, you are increasing the life of that asset. And therefore, that can be recognized as an asset in itself. And the final example I'm going to give, and this is just the final example from my own list, but there are lots of other examples out there, is another way of getting an economic benefit is if you exchange an item for another economic resource, for another item. Yeah. So this could be exchanging debtors for cars or PPE. So if someone owes you an outstanding debt and they can't pay in cash, then you settle it by getting some of their assets in return. Or you could exchange it for the settlement of a liability. So let's say you owe some money. Yeah. An asset could be something to help settle whatever debt you have. Or you could lease that asset for something else, for another economic resource. But essentially in this example, what we're saying is a barter system works. It doesn't need to be a cash exchange, but an exchange of equal amounts. All right? Okay, so now we have understood the different ways an economic benefit can arise. So let's look at the definition of an economic resource again. An economic resource is a right that has the potential to produce economic benefits. So what does a right mean? Well, I know it sounds obvious, but essentially it is a legally enforceable item and is something that can be used, therefore, by its owner. So in this case, the item has a legal right of receipt or use attached to it by the owner. Okay, so you legally have that thing that's going to create money for you directly or indirectly in the future. Okay, so now we know what an economic resource is. It's a legally enforceable item which has the potential to give you some type of benefit economically, directly or indirectly. Now, or in the future. Yeah. So let's go back to the definition of what an asset is. So we've said an asset is a present economic resource. But what does that word present mean? Well, it's there because it has to be an item or an economic resource that we have access to right now. If it is something that we are going to get in the future and there's no corresponding liability that exists for it, then by including it within our balance sheet or statement of financial position, we may be grossing it up. But essentially, we cannot recognize something that we're going to get in the future as an item unless we have an obligation for its liability that exists currently. We must be able to get something for it now. And remember, the balance sheet, the statement of financial position, is a snapshot of a company's position at a point in time. And that point in time may be right now or in the past, but it is not in the future. An asset related to the future cannot exist on it. Remember, the primary financial statements are backward-looking statements, not forward-looking. So, an asset is a present economic resource. We're fine with that. Let's go to the next bit. It is controlled by the entity as a result of past events. What does control mean? Well, we're going to cover control in a lot more detail in another video. However, there are some key things that we need to remember. Normally, people just think of it as, do you own it? Do you have access to it? That means you have control over it. But actually, control encompasses a lot more than that. And there are really two key questions that you need to ask. Do you have the right to obtain the majority of the benefits from the item for the time that you have it? Okay? Do you have the right to obtain the majority of the benefits from the item for the time that you have it? If you do, you control it. If you don't, most likely is you don't control that asset. And the second question we need to ask is, do you have the right to decide what to do with the item? Is it your choice to get rid of it, to sell it? Is it your choice to enhance it? If you do, you control it. If you don't, you may not control it. And there are some grey areas in this, but those are the main two questions you should ask yourself. And if the answer to both of them is yes, then you definitely do control it. The grey areas we will cover in a separate video. Okay, so now we understand that the asset's present economic resource bit, and we understand the bit on control. So let's explore that last little bit of the main sentence, past events. Again, I know it seems really obvious what a past event is, but actually from an accounting standpoint, a past event or a past transaction is one in which a valid expectation has already been created in another party that the entity will discharge the obligation. So what this means is something has happened that has caused another company to expect you to discharge an obligation, to undertake an obligation. And this obligation itself can be contractual or it can be constructive. A contractual obligation is a legal obligation. Therefore, there may be legal recourse or legal action taken if you do not undertake this task or obligation. So what is a constructive obligation? Well, this is defined as per IAS 37. A constructive obligation arises from the entity's actions, through which it has indicated to others that it will accept certain responsibilities, and as a result has created an expectation that it will discharge those responsibilities. So a constructive obligation isn't a legal obligation. However, the actions or past history of a company has indicated that it will do certain things which aren't legally binding, but it will still do them in its normal course of business. So, for example, let's take long service awards for employees. They may not be legally entitled to these awards, but it is customary for a company, and it has historically done so, that it has paid out long service awards of however much to individuals, and therefore it's an expectation, and therefore an obligation is created. More so, you may see retailers' return policies. They may have a strict legal return policy whereby they don't accept any returns over 30 days, or they don't accept it if this is wrong with it or that is wrong with it, or if it's a sale item. But in order not to damage the company's brand reputation, it offers a more generous returns policy which isn't legally binding but is expected to continue. And these are examples of constructive obligations. So now that we have defined contractual and constructive obligations within this overall definition of a past event, being that it is a point in time whereby a valid expectation has been created between two parties, where one will have to discharge an obligation to another in return for a transfer of economic resources. Let's explore how these may occur. So the first one is really simple. An entity has transferred economic resources to a different entity. Okay? Therefore, the recipient has already obtained the expected economic benefits, and therefore it has an obligation to transfer economic resources in order to settle the transaction. So the past event was it receiving the economic benefit. But sometimes a present obligation may arise if the past event has given rise to a contractual or constructive need to transfer economic resources before the economic benefits are received. For example, there may be a requirement to pay for something early, to pay for services early before any work is undertaken. And this may be a contractual requirement, and therefore you have a present obligation to pay now, even before you receive any of that economic benefit. This mainly occurs on a contract where a contract has been signed to provide a service. Now this marries up and is the other side of the coin with the wording within the definition of an asset where it says present economic resource. Yeah? So this is the flip side of that, where it's identifying the present liability that exists, and that comes from the past event. Okay? Now, the last bit is an asset has to be able to have its cost or value measured reliably. Otherwise, there's a risk of a material misstatement or a material error on your balance sheet. If you cannot measure it in any way, internally or using experts externally, it can't be recognized. But this is so rare to not be able to measure something. There are experts on measurement everywhere. So finally, we know what assets are. So the definition: an asset is a present economic resource controlled by the entity as a result of past events that can be measured reliably. So what does it really mean? It's something that you control now as a result of past events that will make you some money directly or indirectly now or in the future. And you gotta be able to measure it. So let's go through some examples of different types of assets and see how they meet the definition of what an asset is. So let's start with cash. Cash is money that you have in your bank account, maybe petty cash or cash that you have lying around. You have received it from a past event. It is yours to do with as you wish. You control it, and you can value it because it's cash. It's what everything is valued against. So that's easy. That's an asset. And cash is a current asset because it's liquid already. A cash equivalent is similar, but it is a highly liquid asset. So an asset that can be easily converted into cash within a 3-month period of time. Now, there's a lot of different things that this could be. It's like marketable securities, treasury bills, certificates of deposit, but essentially it's a cash equivalent because it's unrestricted and it's available for immediate use. Okay, and therefore it meets all the requirements of being an asset. Let's go into something else. Stock or inventory. So these are things that you sell. If you are a company that sells goods, these are the goods that you are selling. Okay, so an asset is a present economic resource controlled by the entity. If you have your own stock, it's your own resource. You have it now, and you got it as a result of past events because you got it made or you had previously ordered it. So if you have it now, if it's stock you own now, then it can be considered as an asset. Okay, the next one. We're going to discuss trade and accounts receivable. These occur whereby you have provided a service or you have sold a good and you now want your money in return for undertaking that service or distributing that good. So you send out a bill. That bill is a document which says you, company X, owe me money. Okay, and therefore you also have the right to pass on that right of receipt onto someone else. You can then sell that onto someone else because you have already discharged the duty or the good itself. Okay, so if that is the case, that's a trade or an accounts receivable. So next are prepayments or prepaid expenses. These are items or services that you have paid for in advance, and therefore another company or whoever it is has to discharge an obligation on themselves to provide you that asset or that service. Then let's move on to investments. Now these can be investments in the stock market. These can be investments in your own companies, subsidiaries, or associates. These cover a wide range of things, but essentially these are shares or holdings in companies that you have, and they are yours to use as you wish. Now, if you wanted to sell those on quickly and make a quick profit from it, they're current assets. If you wanted to hold them for long-term maturity or hold them for to make gains off from dividends, etc., then they're non-current investments. Okay. We then have fixed assets. Fixed assets such as land or buildings or cars or PPE or hardware, plants and equipment. These are mainly used to enhance the value of other assets or to help a company create a service or a good themselves, rather than being the good or the service in its own right. Okay? So they are something that helps create value for the company, either through the creation of products and services, or through the enhancement of value for assets that already exist. You then have intangible assets, which are assets you cannot see or touch. Yep. Similar to fixed assets in the sense that they're there for a long-term purpose to help you do the work, or to enhance another asset in itself, or to help create another asset. And these are things like software. You also have goodwill. Goodwill is the difference between the net assets transferred in a business combination and the consideration that is paid for the company acquiring those net assets. We'll cover goodwill in more detail in later videos because it's a bit more complicated than that, but that's the overall gist of it. That's also considered an asset, a non-current asset. And then lastly on my list, but there are a lot more things that can be assets, lastly on my list is accrued income. This is income that is owed to you whereby you haven't billed it yet. So let's say you've undertaken the service, or you have sent out a good, but you haven't sent the bill yet to claim that trade receivable. That therefore is considered as accrued income, money that's still owed to you under the matching concept of accounting. Right, the last thing to consider is, when do we recognize assets? Now, we've covered one of these bits off before, which is an asset can only be recognized when its cost or value can be measured reliably. But secondly, an asset should only be recognized when it is probable that any future economic benefits associated with the item will flow into the entity. Okay, so when we're expecting money to come in, when it is probable that that will occur, that is the point in time in which we can recognize the asset. Thank you for watching, everyone. This is the Accounting Tutor signing out. Again, please support me on Patreon. If you like the video, please press the like button. Please subscribe. Please tell your friends or anyone that's interested in accounting about me. And if you have anything that you want me to cover, then please leave a comment in the comment section. Thank you again for all of your time. Take care. Bye.